What's going on, guys? In this video, I'm going to show you one thing that we are all guilty of in the stock market. Just by looking at this picture right here of this plane, you already may know what I'm going to be talking about, but that is survivorship bias. So I'm going to dive in real quick for those of you who don't know. Survivorship bias was kind of brought about by this mathematician, Abraham Wald, in World War II or around World War II. And pretty much their goal was, hey, how can we prevent planes from being shot down? How can we have more of our planes come back? How can we protect them? Now, you may be wondering, hold on, how does this relate to the stock market? You will see in 1 second, guys. I'm telling you, just stick through this really quick. So pretty much they would get all this data of planes coming back from battle, and you can see these red dots everywhere represent where the planes have been shot. So you could see a lot in the wings, over here, down here, pretty much wherever the wing is, there's a lot of bullets. There's no bullets here, and there's no bullets here. So right here sums it up really well. So pretty much here's our data. We have planes coming back. All these bullet holes represent all of the gunshots on the plane. So initially, that's this picture right here. Initially, we would think, hey, we should armor up the wings. So let's put more armor here, and let's put more armor here. Because remember, we can't put armor everywhere or the planes would be too heavy. So they got to strategically allocate where they're going to put more armor. And that's everyone's initial first thought. Let's put it where there's plenty of bullet holes. But that's the wrong school of thought. This is where you actually want to pad the plane and where you want to put more armor, because you got to remember, we only have the data of the planes that are surviving and the planes that are coming back. So these planes survive because the bullet holes are here and here, which clearly are not as important. Nobody's coming back with bullet holes here because anyone who gets shot here is not coming back. Same with the cockpit, the engines, and then what's ever going on in these sections of the wings. You can see there's not as many bullet holes. So this is what survivorship bias is, and we all suffer from it because just from the initial looks of something, we all assume, hey, this is where the damage is. Let's put it here. And we forget about this. So how does this relate to the stock market? Well, here's 3 stocks that I guaranteed we all suffer from survivorship bias. GameStop. How many of us actually have GameStop in our portfolios? Apple. I'm guilty of that. I have Apple in my portfolio. And good old Tesla. These 3 stocks we are all piling our money into purely based off of survivorship bias. Now, yes, they all have their different fundamentals and bullish cases of why it's a good pick. But most of the time, the average investor, the naive investor, someone who's just starting out, or even the skilled professional, self-proclaimed professional, someone who thinks they're good enough to have a YouTube channel, right? I'm not necessarily the best trader. I know I'm not. I've lost plenty of money in the market before. But I put money into Apple purely because everyone else was doing it. And if you look back, it's one of the best stocks in all of history. So I thought, hey, people were able to make money for all these years. Yeah, this is a great spot all the way up here. But we all know past data does not predict future performance. This could be it for Apple. All companies come to an end eventually. So when is Apple's days going to come? Why did I put money into Apple? It was not because of financial analysis. When I first invested in Apple, I had no clue what financial analysis was. GameStop, I personally think, not hitting on anyone who's investing in it, but I personally think is one of the dumbest bets now. You had people that made a lot of money from this short squeeze last year, but guys, it's over. I really don't think that's going to happen again. I could be wrong. It could happen, but I personally, and plenty of Seeking Alpha authors, Wall Street, and Quant all kind of agree with me. It's not a good buy. And look at its factor grades. We got valuations a D minus, profitability is a D, revisions a D. You got momentum because of what happened last year, and growth again because of what already happened. But it's not a good trade in my opinion, and a lot of other professionals who are much smarter than me, a lot of their opinions as well. And then good old Tesla. Yeah, Tesla's a great stock, but I would say it's pretty overvalued. If you got in when it was all the way down here, then that's great. You probably made a lot of money. But now it's up to $975 as I'm recording this, kind of hovering around 1,000. Doesn't mean it's going to 10x again, but people are piling in because they saw everyone back in 2019 and 17, all these smart investors made a killing on Tesla. So you may be asking, all right, I'm new to this. What should I invest in? How do I avoid survivorship bias? Well, it's pretty easy. I'm going to give you 3 examples of stocks that may not be on your watch list, and you may not think, hey, this is a good buy, but time will tell. And there's one thing that I am looking at with the 3 stocks I'm going to go over in a second. But before that, I just want to let you guys know, if you want all of this data with Seeking Alpha Premium, if you actually go into the link of this description, of this video's description, you could get 50% off premium. Highly recommend it. It is an absolutely great program, and it's pretty much where I get all my information. So check that out, link in the description. But the very first stock is Wells Fargo. I doubt this is popping up on anyone's watch list. I mean, sure, it's popping up on people's watch list, but the average investor is not looking at Wells Fargo. But why is this a better stock, and why is this something that survivorship bias is not kind of in play? Well, look at the past 10 years. It really hasn't been the best trade, but you need to look into the fundamentals of a stock. I've learned over the years that is so important. Don't just buy a stock based off of how the chart looks. Like, oh, Apple's chart looks beautiful, I hope this continues to go up. It doesn't have to. It could be like IBM. IBM was kind of the Apple of the 80s. And if we look at the max, look at this. This was a great run up. I mean, from the 70s to the 80s, kind of peaking in the dot-com bubble. It did kind of tread a little bit. Then it had another run up. But since 2012, it has been in a bear market. So it hasn't been the best trade. I'm not saying it's bad now. It could potentially be a good trade now. But back in 2012, there were plenty of people that thought IBM will just continue to go up. It's an unstoppable stock. Nothing's going to stop it. Who's to say this isn't what's going to happen to Tesla, Apple, or GameStop over the next 8 or 9 years? It could very well happen. So there's stocks like Wells Fargo. Another one is HP, the HP computers. Pretty sure we all know about them. And believe it or not, Best Buy. So what do these 3 stocks have in common, and why am I focusing on them? By the way, I don't own any of these 3, but I would say that these 3 could potentially be good trades over the next couple years. Remember, this is not financial advice. Just want to put that out there. Disclaimer that I'm not a financial advisor. Do your own research. Consult with financial advisors before you invest in anything. This is purely education and entertainment purposes only. But why am I talking about these 3? If you look into their fundamentals, and we could deep dive into the financials and all of that, but one thing really quick is the PE ratio. So if you look at these companies' PE, or at least their forward PE here, a 10, HP has a 9, and Wells Fargo, all right, it's a little bit high, it's a 12, but these numbers are numbers that Warren Buffett looks at. He wants to invest in stocks that have less than a 15 or even less than a 10 price to earnings ratio. He would not touch Tesla with a 9-foot pole with a PE ratio, a forward PE of 95. Apple, he is invested in Apple. Its PE is a little high. He has made a lot of money off of Apple, but that's because he started buying Apple before this great run up. He was buying Apple before 2020. And then when everything crashed in 2020, everyone was making fun of Warren Buffett for still holding on to Apple. And they were all laughing at him because he was selling Delta Airlines and stocks like that. But he continued to hold on to Apple, and it went from 56 all the way up to 165. That's more than a 200% return in 2 years. It's a massive portion of his portfolio now, about 40%. Will he sell Apple? Possibly. I would assume that he wouldn't sell it so quickly. But that's another problem. People look at Warren Buffett and say, well, Warren Buffett has Apple, so I should own Apple. Yeah, but Warren Buffett bought it when it was $56. Warren Buffett bought it even when it was lower than 56. It's now a lot different. It's 165. It's not as good of a trade now as it may have been back in 2020, back in 2018. And GameStop is just one that he would never touch. I mean, doesn't even have a PE ratio because it's negative. If we look at its financials, it's probably not a pretty picture. We could see revenue has been trending down for over 10 years. Net income has been negative for the past 5 years. Well, the past 4 years. Think of that. If you're going to invest in a company, because that's what you're doing, we're not just buying tickers, we're buying actual companies. If someone were to come up to you and say, hey, I have a company that's losing anywhere between $250 million and $500 million a year for the past 4 years, you want to be an investor? You tell them no. But not that many of us will look into that. We'll just see a chart that looks something like this. Hey, we're all going to the moon, so let's invest in GameStop. And maybe you're someone that you just came to this video because you want to know, hey, how do I not mess up investing in the stock market? How do I make money over the long term so I could retire and live comfortably? I don't want to deal with trying to trade in and out of these stocks and keeping up with what their PE ratios are or how their financials look or if they're overvalued or undervalued. And one of the best things to do, and again, not financial advice, but there are plenty of financial advisors who will preach this to you. You just buy into an index fund like the S&P 500. This is 500 of the biggest companies in America by market cap, and you could just set it and forget it. This is how most people win the market. Not that many people could actually outperform the market in the long run. So if you can't beat them, you might as well join them. And it is a big strategy that I do, at least for my 401k. Yes, I do have individual stocks. If you've watched my channel, those are my portfolios that I like to play around with because I'm kind of a narcissist and I think I could beat the market. But chances are I probably won't over the long run. But it is fun and it is what I like to do. But if you're someone that just wants to play it safe and not have to worry about the ins and outs of the market and what's going on, this is your answer right here. Again, not financial advice, but anyone would tell you. And if you're wondering, hey, what's in the S&P 500? Here's the top 10 holdings. You can see Apple's number one, Microsoft, Amazon, Tesla, Alphabet, NVIDIA, Berkshire Hathaway, Meta Platforms, and United Healthcare Group. These are all companies that we know and have been using every single day. These are all popular companies that we know. And the beautiful part about index funds is if Apple does so happen to fall off the face of the earth and turn into the next IBM and doesn't perform over the next 10 years, that's only one of 500 positions. It's not going to kill us. It's not going to kill the S&P 500. A newer, smaller company that might be worth less than $1 billion could become the next Apple in 5, 10, 20 years. And the S&P 500 is going to benefit from all of that appreciation for the years to come. But I think I've been ranting long enough and this video is getting long enough. Now you guys know what survivorship bias is and how to try to avoid it. If you like this video, make sure to smash that like button. And guys, as always, I will see you in the next one.